Check out the programs on learning everything about real estate and stocks that I know. Get my brain dump if you want to know what I know about researching how to get great deals in real estate, save hundreds of thousands of dollars of buying real estate or renovating correctly. Check out the programs, a link down below on real estate investing. That's going to be a big deal going forward. And of course, my theses on stocks. So check those out, link down below. There's a coupon code expiring in 10 days, and we're going to have the largest price increase ever thanks to that inflation. Thanks for watching. All right, let's get to some other updates. Hey folks, so quick summary on the jobs report. It's actually pretty good news. Like last year, we had these crazy disastrous jobs reports where you'd have non-farm payrolls come in at like 800,000 when the expectation was 400,000, and then you'd expect 400 and it'd come in at 700,000, and you had these crazy wild swings on jobs days. And there's potentially a belief that maybe we had such a crash in markets yesterday because people were fearful that, oh no, the jobs report coming up was going to start showing signs of stagflation, which potentially could be a sign that, well, obviously the economy would be stagnating, evidenced by potentially fewer jobs, like a jobs miss, while at the same time, inflation, you could have potentially had average hourly earnings go up in March, which, in April, which would be a terrible thing, because then you'd have potentially less hiring at higher prices, and then that's where you get to even less productivity, and you get more of that stagflation. That's not what we got here. What we actually got was a stable unemployment rate. We were expecting it to go down a notch, 0.1%, down to 3.5. It stayed stable at 3.6. We got 428,000 jobs, non-farm payroll jobs. We expected 391,000. Total business jobs, 406. We were expecting 380. So slight beats, like nothing like overly hot. Like this is pretty much right at expectations. But here was some magic, okay? The average hourly increase month over month was 0.3%, which if we annualize that by multiplying by 12, we get a 3.6% sort of speed that we're moving at in terms of wages going up. That's obviously still more than the 2% that the Fed wants, but it's way better than the nearly 9.6% that we thought we had in January. That ended up getting revised down to 6.6 in January, eliminating or at least reducing some of the fears of the wage price spiral. But every jobs report since then, we're like, are we going to see that wage price spiral come up again? And we didn't really see that here. Now, even though last month they revised up 0.1% for the month over month, both months still below expectations and still coming in way softer than inflation. So no evidence of that wage price spiral here, which echoes what Jerome Powell told us just 2 days ago. No evidence of a wage price spiral. Because remember what Jay Powell says, if we saw evidence of a wage price spiral, they would have to deal with it, because a wage price spiral can lead to regime collapse. Just in case you're not super familiar with that, here's just like a quick 20-second explanation. If wages are in a wage price spiral, wages go up, which allow individuals to go buy more stuff. Because they're buying more stuff and wages are up, businesses feel they have pricing power, so they raise prices more, and then you get wages that are now demanded to go up even more because prices are higher. And so you kind of get this like stair-stepper effect, and that could be entirely uncontrollable and could lead inflation expectations to go through the roof. So that's not happening, which is good. Factory hours worked went down slightly under expectations. We were expecting 40.7 hours worked, went down a little bit to 40.5. Not sure, if there was anything in particular in April here other than supply chain issues, which could be to explain this, but this is a relatively a nominal move there. Average hours worked were expected to be 36.7, came in at 36.6. So only a slight little move there, not sort of a big difference at all. I actually messed that up by a factor of 2 hours there, but roughly the same difference anyway. So the expectation was 34.7. We got 34.6. So still just pretty much along expectations here. So look, takeaways here. The biggest problem of this report is that labor force participation went down a little bit, went down 0.2%. This is kind of bad for the Fed because the Fed wants labor force participation to go up, not down, especially when we have 1.9 job openings per unemployed person. It's like, why? Why is labor force participation going down and not up? And it could entirely be because people have a whole lot more savings than they used to have. People don't necessarily have to work right now, which is really wild. Let me give you a couple notes here. So in late 2019, just before the pandemic began, the combined household net worth in the United States of individuals was equal to about 8 years of consumer spending. So that means like if you took everybody's net worth and combined it, we would get roughly 8 years of spending. Well, thanks to the pandemic, now we're at 9.5 times, combined household net worth for 9.5 years of spending, basically, compared to 8. Now, that might seem like, wait a minute, but that's only a year and a half more of spending. That's a lot. That's another year and a half of GDP. That's like $30 trillion. It's insane. But when you compare it to 2011, it becomes even more apparent. When you compare to 2011, you're actually 50% higher with the amount of spending that we're capable of doing compared to 2011. Here, let's make it a little bit more simple. The average US household net worth right now is capable of supporting 140% more consumption than it was 3 years ago. So yeah, even though things are poopy doopy in the markets right now, people have more money and they can spend more money than ever before.